Artificial intelligence is the hottest sector in the market right now, but investors are overlooking a critical piece of the puzzle: the companies that supply the hardware behind it. Over the past few years, artificial intelligence has driven a massive rally across the market, from software giants like Microsoft and Google building advanced AI models to hardware leaders like Nvidia and AMD designing the chips that power them. But there is a critical layer of this ecosystem that investors are overlooking: the suppliers. Behind every advanced chip, there are specialized companies providing the materials and components that make these systems possible. Without them, the entire AI value chain simply doesn't function. One of those companies is Qnity. Qnity develops advanced materials and solutions for leading semiconductor manufacturers including Samsung and TSMC. And despite its position in this critical part of the supply chain, the stock is currently trading around $138 with a price-to-earnings ratio of about 40 times, well below the sector average of roughly 60. What's interesting is that, in several key metrics, Qnity actually outperforms many of its peers, yet the market continues to value it at a discount. I first covered this company when it started trading at $90 in October 2025. Just a couple of months later, the stock dropped to $70, a decline of about 20%. Now, 5 months after that low, it has reached $138, delivering close to a 100% return from the bottom. This kind of volatility is not unusual. As I've mentioned in previous videos, it's a typical pattern in spin-offs, often referred to as the spin-off sell-off. Newly independent companies tend to face temporary selling pressure as institutional investors rebalance or exit positions that no longer fit their mandates. Qnity itself was spun off from DuPont, a long-established industrial company that has increasingly focused on advanced materials and technology-driven solutions. In recent years, DuPont has streamlined its operations through multiple spin-offs, with the goal of creating more focused and specialized businesses. This is a common strategy. By separating divisions into independent entities, companies can operate with clearer priorities, and in many cases achieve more accurate valuations, especially when those businesses serve niche, high-growth markets. In this context, Qnity emerged as a standalone company focused especially on supplying materials and equipment to the semiconductor industry. As an independent entity, it now has greater flexibility in areas such as partnerships, operational structure, and long-term strategic planning. But there is also a more important driver behind the spin-off: positioning. By separating Qnity, the market can begin to value it more in line with companies tied to the AI ecosystem, rather than as part of an industrial conglomerate. And that distinction matters because AI-related companies are currently trading at significantly higher multiples. We've seen a similar dynamic play out with SanDisk. The company focuses on data storage, providing flash memory and solid-state drives that allowed AI systems to store and process massive datasets efficiently. After being repositioned within the market as a key enabler of AI infrastructure, its valuation expanded dramatically. The stock went from $30 to $900, a 3 times increase in just 1 year. Qnity is aiming for a re-rating. By standing on its own as a critical supplier within the semiconductor and AI value chain, it has the potential to be recognized and valued as an essential part of that ecosystem. Qnity entered the market with solid fundamentals, positioning itself as a standalone company without structural weaknesses. It generates $4.7 billion in revenue and $0.7 billion in net income. That translates into a net income margin of about 15% and a return on assets of roughly 5%. Both metrics are meaningfully above sector averages, which tend to be closer to 5% for net income margins and 3% for return on assets. The balance sheet reinforces that strength. Qnity holds $14 billion in assets against $7 billion in liabilities, implying an assets to liabilities ratio of 2 times. For a company operating in the semiconductor supply chain, that's a solid financial position. At its current price of $138, the stock trades at a price-to-earnings ratio of around 40. On the surface, that may appear high, but when you consider its above-average profitability and its exposure to a high-growth segment like AI infrastructure, that valuation becomes more justifiable. Since becoming an independent company, the stock has been volatile. After dropping to a low of $70, it has rebounded to $138, representing roughly a 100% increase from the bottom. This suggests that the market is gradually moving toward a more accurate valuation. However, being part of the AI ecosystem has both advantages and risks. While it benefits from strong demand and premium valuations, it is also highly sensitive to shifts in sentiment around the sector. As a result, continued volatility should be expected. In conclusion, Qnity stands out as a fundamentally strong company. It combines solid margins, consistent growth, and a healthy balance sheet, supported by its position in one of the most attractive sectors in today's market. At the same time, the opportunity is not as compelling as it was at the beginning. The stock is no longer trading at the same discount it has shortly after the spin-off process, which could limit the upside from here. This highlights an important takeaway. With the spin-off stocks, the most attractive entry point often comes early, during the first months of trading, when selling pressure and market inefficiencies can create temporary mispricing. That's where the real opportunity tends to be. On this channel, we focus on identifying and tracking these spin-offs, both before and after they start trading, with the goal of capturing those early-stage opportunities. If you're interested in this strategy, consider subscribing to follow future analysis. See you in the next video.